Once upon a time, in a bustling city, there were two friends, Sam and Alex. Both were entrepreneurs, and they each needed a loan to expand their businesses. But here's the twist. They had different types of loans with different interest rates. Sam ran a cozy bakery and had taken out a loan with a fixed interest rate. This meant that Sam's loan payments were consistent every month. For Sam, this was nice because he knew exactly how much he'd need to pay, but sometimes he felt he was missing out on potentially lower rates if interest rates went down. Alex owned a tech startup and had a loan with a floating interest rate. This meant that Alex's payments varied based on market interest rates. When interest rates went up, Alex's payments increased, but when rates went down, his payments decreased. It was a bit of a roller coaster ride for Alex. One day, Sam and Alex were chatting over coffee and came up with an interesting idea. Why not swap their interest rates? Here's how it worked. The swap agreement. Sam and Alex agreed to a swap where Sam would take on Alex's floating rate and Alex would take on Sam's fixed rate. This meant Sam would start paying Alex's floating interest rate, which could vary with market conditions. Alex would start paying Sam's fixed interest rate, which stayed the same no matter what. Sam thought that interest rates might drop in the future, so he wanted to benefit from Alex's floating rate. Alex was worried that interest rates might rise, so he preferred the stability of Sam's fixed rate. In an interest rate swap, the two parties agree to exchange or swap interest payments based on a notional amount, which is just a placeholder figure used to calculate payments but isn't actually exchanged. Here's the simple breakdown. Initial agreement. Both Sam and Alex agree on the terms, including the notional amount and the timing of payments. Payment exchange. They swap interest payments based on the agreed terms. Sam pays Alex based on the floating rate. Alex pays Sam based on the fixed rate. Net payments. Often, only the net difference between the two rates is exchanged, making it simpler for both parties. Benefits of interest rate swaps. Risk management. Sam and Alex were able to manage their interest rate risk more effectively. Sam wanted to benefit if rates fell, while Alex wanted protection if rates rose. Flexibility swaps allow businesses to tailor their interest rate exposure to their specific needs and market views. Cost savings. By swapping rates, they could potentially reduce their overall interest expenses or stabilize their cash flow. In the end, the swap worked out great for both Sam and Alex. Sam enjoyed lower payments when rates fell, and Alex benefited from the stability of a fixed payment despite rising rates. They continued to expand their businesses and frequently shared stories of how their clever interest rate swap helped them manage their finances better. Summary. Interest rate swaps are like a financial tool that allows two parties to exchange interest payments to better match their needs and preferences. It's a smart way to manage risk and adapt to changing interest rates. So, just like Sam and Alex used their swap to balance their financial needs, businesses and investors use interest rate swaps to tailor their interest rate exposure and manage financial risk. If you enjoyed this story and found it helpful, be sure to like, subscribe, and hit the bell icon for more engaging finance and accounting content.